And welcome to CNBC-TV18's Big Deal. Now let's put the spotlight on the state of affairs in the startup space. Now at a time of funding winter along with challenging macros and volatile equity markets, what are we glaring at, especially for the unicorn club of Indian digital sector? Let's find out from two veterans, Mohandas Pai of Aarin Capital and Sanjeev Bikhchandani of Edge. Welcome, gentlemen, to Big Deal. Always a pleasure welcoming you on CNBC-TV18. Now, both of you have seen several cycles of boom and bust. Mohandas Pai, let's begin with you since you hail from the startup headquarters of Bengaluru. So how's that side of the world faring now in the current environment? And what's the big worry currently?
Well, I think it is a very mixed thing. Please remember, last calendar year, India got $25 billion of capital coming in.
Yes.
Basically, in the first 9 months. Before that, we got 42 billion. Before that, we got 12 billion. Right now, Series A and seed capital is coming in on a more selective basis. Series B is more scarce, and there's almost no Series C. So no large checks are coming in because the large institutions have been very quiet. And they're very quiet basically because of the global financial uncertainty, largely in the United States. In the United States, there's a fear that the Fed is going to raise interest rates even more. And that's because in January, I think there's a bump up in inflation, which was unexpected. Otherwise, the rate curve was inverted. So unless the interest rate scenario settles down and stabilizes, people may not look at increasing the allocation to risk capital, riskier capital. There's a flight of money to fixed income. So essentially, it's a question of funding and global allocations of capital. But at the seed and Series A level, things are going on at a fairly more selective basis, which is very good. And startups are tightening the belts, running their budgets very carefully, cutting down unnecessary costs. So I think there is rationality that has come, and many people are waiting for the next big upcycle when money will start flowing in.
All right. Many people are waiting for the next big upcycle. But Sanjeev Bikhchandani, I'm sure we have a very long road to really traverse before we get to another upcycle. What is the timeline you're looking at when it comes to the current funding winter as well as the several other macro challenges? And when do you think the market is likely to turn in the interim? How do you see the picture?
Well, as Mohan said, investments are happening selectively. A later stage, of course, is much more discerning. And early stage also has become discerning. But later stage is really quite discerning. But, there's always money available. There's enough money in the system. Funds have money. There's enough money in the system for the right companies. So if you're running a good company, by good now, I mean, there's growth. There's good solid unit economics. There's path to profit or perhaps even profit. You will find your money. So really it's about how well you're running your business. And and certain companies will not get the money unless they are able to drastically improve their operations, which may or may not happen.
Right.
So I'm not despondent.
Yes.
I would focus on company fundamentals rather than waiting for upcycles.
Right. So that's a fair point. And Sanjeev, since you are in the equity market, several of your companies as well, one thing is a standard principle of investment, that is money is available more freely in good times and it is constrained in bad times and difficult macro environment. And that is not just for the startup world. It is true of the publicly listed companies in the public market as well, where we have seen all sorts of fundraising take place for all sorts of companies where now it is fairly constrained. But I want to ask you one thing, that there is a critical mass of unicorns which are in the listed universe right now. How do you see the valuation dynamics as well as the challenges that they are likely to face in the near term from your point of view?
So the advice we give people and the thinking we follow ourselves is something which somebody told me about 20 years ago, or maybe 15 years ago, a few years after we listed. This market goes up, you run the business. Market goes down, you run the business. Market goes sideways, you run the business. You don't worry about valuation, you just run the business. Valuation is something the market gives you, or it doesn't give you, or and that's up to the market. But don't get obsessed with your valuation, obsessed with the business fundamentals.
Yes. So Mohandas Pai, that is the basic rule of doing any business. But currently valuation is is a matter which was a worry some time back. Now the bigger worry is also survival and also getting enough cash to run the business till the difficult environment really persists. How are you seeing this present situation, and crystal gazing into the immediate term in this year, how are you seeing the startup ecosystem develop?
Nisha, first let me talk about the unicorns that got listed. I think they made many strategic errors. One was believing that they are there to cream the market and get the highest price when they go for IPO, which is a big mistake, because when people come in for IPO, they want to make money. And when you take away all the value on the table, there's no money left. If something happens, stock price falls and your reputation is destroyed. Second, they went in for more offers for sale instead of getting cash into the firm. High offers for sale driven by investors on the cap table means that they get out and you hold the baby. What is important in the listing is not the 15% dilution that you make at a high price. How do you protect the value of the 85% who remain with you? And they forgot that. And the third thing was the lack of adequate standards. How many of them report within 15 days? When the software service industry happened, we all reported within 10 days, 12 days. We set standards. We had high quality disclosure. Look at the kind of disclosure. Many people talk about adjusted EBITDA and all kind of things. India, when you use the word adjusted, it means that something is wrong with your figures. Whereas the US, adjusted is understood for what it is, to show cash flows. And the last thing is that hubris and arrogance. I will not meet analysts, I'll meet this, I'll meet that. They must remember in the public markets, there are many, many options. They're not wedded to you. You're not the prima donna. You're one of them. So you don't go and market. They're not going to look at you. They're going to sell. And analysts and people, brokers make money both ways, when it goes up, when it comes down. And the last point, Nisha, very importantly, is many of them have their old investors selling, like it happened in delivery, right? Why can't they go tell all the old investors how much do you want to sell, appoint a banker and help them place it with large institutions so the market is not shocked. Every time the price goes up, somebody is selling. I think a lot of strategic errors have to be made. And I hope the next cohort of startups who list will not make this kind of errors. We'll have more reasonable valuation. Now, what we're telling startups is keep your money in the bank, cut your costs, get ready for raising capital. And the good ones are able to raise capital because for the good ones, like Sanjeev said, where growth is there, they're doing it in a cost-effective way, the losses are reducing, they got operating leverage, the existing investors are willing to put in money. And the existing builders are willing to put in money at reasonable valuation, and they're able to get other people to put in money. So good companies are able to raise capital. But the bad companies are really in bad shape. And I think many of them will die in the near future, even if they're very big companies, because they're running out of capital. So I think it's going to be dicey for this quarter. I think the middle of next quarter, we could see money coming in, subject to the interest rate scenario in the United States settling down. The moment interest rates stabilize in the United States, there's no fear to go up again. Then I think within a short while, the market will be much more normal. They can raise capital because the US is the largest source of funding. We shut out China, right? So US is the largest source of funding. And I think the US economic condition, the key to watch. But good companies are able to raise capital even now.
All right. So many takeaways from there, Mohandas Pai. And some of the most important takeaways are that there will be visibility after 2 quarters on interest rate in the US. And then we'll probably see some bit of investment come back. But it is likely to be difficult next 2 quarters. And one thing you mentioned about was the adjusted EBITDA, reportage that we have seen by some of the companies. Sanjeev, would you like to jump in on this? What's your view on that?
I'll talk about the companies I know where we are shareholders and investors. Let's take Zomato. Zomato reports both EBITDA, right? And then it reports adjusted EBITDA. And now what is EBITDA adjusted for? It is adjusted for the ESOP charge, basically a non-cash expense. Now, is ESOP a real expense? Answer is yes. Is it a cash expense? It is ESOP given before the IPO, which has been charged off over several quarters. Now, why is it useful for some investors to know both EBITDA and adjusted EBITDA? While analysts and institutional shareholders are sophisticated enough to remove the ESOP charge if they want to study cash flow, perhaps for retail investors, they may or may not have the expertise or knowledge. And therefore, adjusted EBITDA becomes useful because the actual cash sort of EBITDA may be a clue to the future of the company. Now, this is particularly important if this kind of levels of ESOP rewards are not going to be repeated in the future. and was a one-off, but is being charged off over several X quarters. So to my mind, if they're revealing both EBITDA and adjusted EBITDA, I mean, it's okay.
All right. So that's your view coming in on adjusted EBITDA, which has been a huge talking point. But will it cut ice with retail participants in the public market needs to be seen. In fact, we'll chat more about the retail participation as well as the public market view on the startup space and whether the startups have any chance of an IPO in the near term. We'll discuss all that and more on the health of the unicorn and what lies ahead right after this short break on Big Deal. Stay tuned. You're watching Big Deal and we are discussing the way ahead for the unicorns in the country, and Sanjeev Bikhchandani as well as TV Mohandas Pai are here with us. Now, we were discussing the public market approach for the unicorns. There are several lessons that are learned after the last wave of the IPO. Sanjeev Bikhchandani, how do you see the public markets giving another chance to the unicorn world now, and how long will it take for that to really return?
I think, for a while, the Indian market looked like they would accept loss-making companies going public and giving them a runway of 2-3 years to sort of get to profit. I think the market right now is spooked enough to be a lot less tolerant of loss-making startups trying to go public. Certainly not at the valuation that they hope to go public at, and not at the valuations at which the last private round came in. And therefore, you are going to find that in order to go public, if some companies have to do that, they might go below their last round private valuation, which may not be acceptable to their private shareholders. So it's a kind of a stalemate. And for that reason, I think it's possible that very few IPOs happen among the tech startups in the immediate future.
Right. So, Sanjeev, when do you foresee any markdowns, if at all, to happen publicly, to be announced? Are you foreseeing that happening anytime soon? Because in the past, contrary to the expectation, it has happened and then consolidation has taken place for survival. We have gone through that cycle once.
Yeah. So, look, shareholders don't like to go public with a down round or a markdown, or it's kind of embarrassing, right? And therefore, if a company is running out of money and it doesn't look like it get to profit with the next infusion of capital, shareholders may prefer consolidation. So, it's a case-by-case basis. We have to wait and watch and see what happens.
Right. Mohandas Pai, what do you see happening as an out for the investors? Because public market is not giving that exit once again. And there are very few other secondary transactions that can take place. M&A consolidation, is that beginning to now emerge?
Well, see, my view is very simple. The public markets will always give you money if you come in at a reasonable valuation, because investors will invest when they see a good chance of making money. So the valuation is the key, and in the bad market, it has to be much lesser than in the good market. Now, second, about the markdowns, I think the markdowns will start with the foreign funds, because foreign funds value companies every quarter, most of them based upon cash flows and the models on which they invested. Whereas Indian funds will value them based on last round valuation, unless there is a much greater calamity happening, like the company running out of cash and a going concern being of concern. That means it's no longer a going concern, doesn't have enough cash to last the next 12 months. Some of them could happen. We have to wait for this March quarter to end, because in the December quarter, we don't seem to have seen much of that. Not any, I think. So March quarter, we have to wait and see. So I think our M&A is going to happen. The smaller companies will have more M&As, because big companies, I don't know why people will pay value for some of the bigger companies unless they get their distress. So people should be very ready. But what could happen for companies which are viable, which are growing, which may not have cash, is the existing shareholders will come and put in money to keep the show going on condition there's a deep cut in costs, more efficiency, so that the economic break-even comes much earlier.
Right.
So I think the big issue for all companies today is how will you make sure that you have a runway of cash to survive, and how long will you survive, and how do you demonstrate good performance to get more money? And I think money is available for good companies, and money is available for companies who show performance from existing investors too. But valuation is the concern overall, and money is the concern for companies which build their model on just raising money and throwing money and spending money for them. And for other companies which are showing improvement, I think money is available. It can either be from existing shareholder or new shareholders. New shareholders will demand a lower price, so existing shareholders will have to cough up money to keep the show going till the market revives.
Right. And also in this particular space, Sanjeev, jump in on this. Some of the companies and many of the companies, actually, founders have given up their equity at a very early stage. And now, even in listed space, where their shares are more liquid, can be bought easily, they also run the risk of a hostile takeover. Do you see that also picking up, and some of the old economy, companies with the aspiration of going digital, they are the ones who could really latch on to it because they have been more stable and for many years, and they know how to ride and tide over different business cycles?
Well, my sense is that old economy companies don't really know how to run new economy businesses, right? Which means that if they take it over, will they create value in terms of growth and profit? I don't know, right? The jury is still out. Second about hostile takeover is that, the institutional shareholders have to largely agree either to sell or to back the new buyer. And there you may discover that some institutional shareholders, no matter how concerned they are about stock price declines in the last 6 months, 12 months, may still prefer to back the earlier management. So a lot of moving parts. Let's see.
All right, so a lot of moving parts, but there will be action nonetheless. Mohandas Pai, my final question, which has been the talk of the town actually, is are we going to see a lot of unicorn zombies by the end of this year?
Well, I think so. If you're not able to raise money and you don't have hopes of raising money and your economic model is not working out, you've got to be a zombie. In fact, in most developed economies, 30 to 40% of all companies are zombies, defined as companies which may not be able to earn money to pay their interest on debt fully if the interest rates go up, and who certainly will not earn money to pay back their debts. Now, in the startups, we don't have debt for most of them, so that's not a problem. But here we can define zombies as companies which have no hope of raising money and which are doomed to die unless existing investors put up money, or possibly they cut their burn very, very drastically and change their model. So I think if you look at 108 unicorns, a few of them are impaired or damaged. We don't know who they are. And even if we know, we are not going to talk to you about it, Nisha. So I think we have to wait and see what happens. And certainly there are very big signs that a few of them are indeed deeply impaired.
Right. So, this is one of those conversations, Mohandas Pai as well as Sanjeev Bikhchandani, where it's a teaser to what may lie in the future. And so many questions have emerged now, whether there'll be zombie unicorns, whether there'll be shutdowns, whether there'll be hostile takeovers.
If you recall the movies from the 70s and 80s and that Ajit dialogue, liquid oxygen, a zombie unicorn is liquid oxygen. It won't die. It won't grow. It'll just drift along. And it'll still claim its last round valuation as fair valuation, but will not be able to raise more money. So it's in liquid oxygen.
Right. And wait and try to tide over and wait for the right time, probably. All right. Thank you so much, Sanjeev Bikhchandani as well as Mohandas Pai, for this riveting conversation. And we'll keep our eyes and ears open for the unicorn world and what's developing there. Lots of action expected this year for sure. Thanks so much for joining us on Big Deal, and stay tuned to CNBC-TV18.